What's up, everyone? It's Connie with MoneyVest. I think it's time for us to talk about PayPal stock, and it's been on a very significant and long sell-off since 2021. So we obviously know that it's not performed really well. So I think it's best that we go over it. And of course, they're reporting earnings next week on November 1st. So I'm going to break down the earnings expectations. I'm going to break down every important metric in this video for PayPal from an earnings standpoint, from a revenue, from a fundamental standpoint. And we'll try to figure out, okay, what is going to be the intrinsic value based on today. And we're also going to reverse engineer a little bit of the math behind PayPal. And we're going to do a reverse cash flow model to better understand, okay, what is the growth rate they need to simply hit in order to justify today's valuation, right? So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. That's all I'm asking in return, is you also subscribe to the channel. And again, link to our Discord and Patreon is going to be down below if you're interested in joining. The 16% annual discount that's available till the end of this month. And you also get access to all the members-only private videos, our spreadsheets, our stock reports, everything's going to be included. And I also want to mention that we do have a Halloween sale going on right now on all the educational courses. So fundamental analysis, technical analysis, options course, and including the bundle, everything's 50 to 60% off. And coupon code is going to be Halloween. Link's going to be down below, and that's available for the next 3 days. That does expire after October 31st. So link's going to be down below if you're interested in joining and taking advantage of that. Of course, you get lifetime access, and all future material content is going to be available to you. And you can also download spreadsheets if you want. So this right here is PayPal's performance. I went ahead and basically put together a nice spreadsheet going back as far as 2012. This is all the fundamentals, right? So we've got the revenue growth over here, we got the gross profit, we got the operating income, net income, we got margins for everything, and of course, shares count, free cash flow, and margins for that as well. So this is going to be that visual representation, and what you've noticed, obviously, right, revenue has consistently been growing, right? Needless to say that it's gone from 5.6 billion to over 27.5 billion. And this year, the expectations are just going to be close to 30 billion. They've guided for 7.4 billion in the third quarter, which again is coming up. So let's just quickly break down the expectations. $7.38 billion, that's going to be the revenue guidance, and $1.22 is going to be EPS expectations for the third quarter 2023 for PayPal. So revenue, very nice growth. Gross profit, you'll notice that we did moderate a little bit in 2022. So gross profit came in at just over 11.6 billion, which was slightly lower from 2021 from 11.9 billion because of slightly higher transaction expense. So that, again, moderating a little bit, spooking investors that, this is kind of a declining business now. But 2023, the expectations would be at close to 12.3 billion for the entire year. So that's, again, going to be reaccelerating in that gross profit numbers for the company. Now, operating income also did decline. So you'll notice it went from 4.2 billion down to 3.8 billion dollars. So that was a little bit of a decline again in operating income because of higher operating expenses. So this is the entire 2022. You'll notice that operating expenses basically all the way down here. So operating income was at $3.8 billion, which was, again, lower than 4.2 billion same time last year. So again, you can see that from 4.2 down to 3.8. And the reason for that, if you come back over to the analysis here, so you'll notice that significant increase in transaction expense that I mentioned earlier, 12.1 billion. So that's a 20% increase on a year-over-year basis. Then we also had transaction and credit losses up 50%, so $1.5 billion. Customer support and operations was up to 2.1 billion, slightly higher from same time last year in 2021. Sales and marketing did decline. We did see a little bit of an increase in technology and development, and general administrative expenses was basically flat. So it was just a margin squeeze there from transaction expense perspective, which is why their take rate was slightly lower than what we have seen in the past, but it was marginally, right? Marginal decline, which obviously led to a little bit of a substantial loss on an operating basis. And then this is where, the most of the damage happened, which was net income, the bottom line, the profitability. And that's really what, Wall Street and investors care about. You'll notice we went from 4.1 billion down to 2.4 billion dollars, a pretty significant decrease on a year-over-year basis. And there was for two reasons. Number one, they had a pretty significant income tax expense of almost $1 billion. So that right there, 947 million compared to a benefit last year in 2021, by the way, it's 70 million. And we also had other expense of about 471 million versus 163 million from 2021. So combined, that was almost 1.5 billion dollars just completely gone from the bottom line for the company. And as a result, profitability did struggle significantly. and it was at $2.4 billion. But guess what? This year, in 2023, they're expected to once again rebound and go up to over 4 billion because they've guided. So if you come down to their earnings expectations, for the full year, they basically guided for $3.49. I don't have that opened up right now, but for their full year expectations, they guided for an EPS of $3.49. Given that the share count right now is 1.1 billion shares, you basically, what you have to do is take the earnings per share times shares outstanding, and you'll get to net income, which again is going to be a little bit over 4 billion. So in other words, if you take 4 billion divided by the share count of 1.1 billion, hit enter, you get $3.49 over here. I know it's going to be really, really small. I'm going to try to zoom in a little bit, but this right here is the number. $3.49 is what I'm referring to, is going to be that GAAP EPS, right? GAAP earnings per share for the business, considering a net income of 4 billion and share count of 1.1 billion shares. Based on today's price of about $50, we are looking at a price to earnings multiple of 14, right? That's where PayPal trades at the moment, of 14. Now, coming over to free cash flows, you can see free cash flows have actually been very strong, right? So a little bit over 4.95 billion. This year, they've guided for $5 billion. So that guidance is over here. So it was somewhere. Oh, there we go. So fiscal year 2023 guidance, free cash flow of a little bit over $5. There we go. Now I found it. GAAP EPS of $3.49, right? So that's what they've guided for. And on a non-GAAP basis, they're guiding for $4.95, which again is significantly higher. So if you do the math based on that number, we are looking at PayPal trading at around 10 times earnings multiple and a non-GAAP earnings per share growth rate of 20%. EPS on a GAAP basis, though, if you take a look, GAAP earnings per share growth is going to be 67%. Let me zoom in a little bit, and that's going to be this number right here, 67%. And the reason for that significant growth is because last year, as I mentioned, that 2.4 billion, 1.4 was already gone in income tax expenses and other expenses, which resulted in a significant decline from 2021, right? So 42% decline in net income last year. But this year, the expectations are for us to see a growth of 67% and for us to see that reacceleration in profitability for the company. So you can see that, this year, 2023, we're going to potentially see that increase on a year-over-year basis. But again, there's a couple more quarters left. We're going to learn about the earnings next week and what their guidance is. So if they reiterate their guidance, it's possible that we do see that 4 billion mark for profitability, or it's possible that they cut their guidance or increase their guidance, depending on what they do. I think the stock's obviously going to move depending on their expectations. Now, when it comes to margins, now this is also a little bit of a concerning piece for PayPal, because for the longest time they've kind of maintained gross margins of over 50%, but that has been on a slow and steady decline. In 2022, they pretty much hit a 10-year low, 42%, and this year expected to be around 41%. But this is what's really spooking investors, is that margins are getting compressed for PayPal. Now, this could be because of competition. This could be due to, the relevancy of the platform itself. But I can tell you, globally, PayPal still has majority of market share when it comes to payments. So that is something to keep in mind. Yes, there's competition coming up, and that's really where a lot of the sort of bearish thesis is coming from. And you can see something like, the stock price like this, right? It's just brutal, right? I mean, it went up and it's now trading at a 7-year, 8-year low since 2021, obviously down over 84% because of that margin compression as well. Operating margins more or less flat, around 14-15%. They have traded as much as 16%. Right now, more or less flat. This is net margins. You can see that they're expected to once again accelerate from 8.5 to over 13.5 because of that net income growth once again. And free cash flow margins also has been around 16-17%. Some years a little bit higher, some years lower. But bottom line is that they are once again going to report positive free cash flow for the company. So, when you look at the business just from a numbers perspective, yes, there's puts and takes here. There's good things and there's bad things. Good things, again, share buyback has been consistent. Free cash flow has been growing at a CAGR of 17%. Net income has grown at a CAGR of 12%. Operating income has grown at a CAGR of 16%. We've got gross profit growing at 14.5%. Revenue has grown at over 17%. But then you've also got margins that have gone down from 52 to 41%. Operating margins have gone down from 24 to 16% down to 14. So there's been 2 percentage point compression there. And net margins have gone down from about 13.5, 14.5 to 8.7. We kind of topped out in 2020 when margins were at 19.5%, then dropped down to 16, then 8.7. Of course, this year, the expectations are once again to reaccelerate to 13.47%. And free cash flow margins have also been pretty stable. So obviously there's good things and there's bad things. If I come over to the transaction take rate, as I mentioned earlier, you'll notice that total take rate has declined from 2% to just about 1.94. So, 6 basis point, 7 basis point decline. And transaction take rate is down from 1.86 to 1.74, right? So about, 6 plus 6, we're looking at 12 basis point decline over the last 5 quarters for the company, which again is marginal. And it has, dropped down further to 1.85. But this again is the lowest we've seen in 5 quarters. So, knowing all of these things, if I come over to the fair value calculation now for PayPal, what we're going to do this time is we're going to actually reverse engineer a few things, and we're not going to be forecasting for the growth rate or anything, but instead we're going to try to match the fair value to the actual market price and then figure out and look at what the growth rate needs to be in order for PayPal to justify today's valuation. Okay? So in this example, I'm simply going to use free cash flow, right? So what I've done here is I've plugged in 2023 free cash flow of $5 billion. That's the number that you guys are seeing over here. And then we're going to grow. A discount rate is going to stay put at 12%. We're going to discount all future cash flows back to present value at a 12% rate. We're going to keep 0% margin of safety for this example, and I'll explain exactly in a little bit. And 0.6% is minus 0.6% is going to be that share buyback. Now, free cash flow growth of, let's just put 4%. Okay, and a P multiple of, right now it is trading at, if you do the math, right now the market cap is a little bit over 55 billion. So 55 divided by 5, we're looking at 11 times price to free cash flow. Let's just go with 12 and see where we are. Okay, $36, right? $36 ends up being the fair value simply based on the free cash flow growth of 4%. Okay, now let's just go with 6%. Okay, so it jumps up to $40. Let's just do a little bit of that margin multiple expansion to, let's say, 14, 47 if you do 15, so $50, right? So this is where we are, which is exactly the same as the market price. And the reason I wanted to do this exercise is to help you understand that, okay, PayPal, based on today's valuation, today's market price, and the fair value being at $50, if both of those numbers are the same, would need to grow at 6% only. Only 6% free cash flow growth needed for PayPal, and a 15 times multiple, right? That's only 4 points expansion to give us a market-beating return of 12%, right? Now, if we disregard the free cash flow and just run the earnings analysis, so if I do 100% here this time, we're going to switch over to net income. Net income is going to be about $4 billion, right, this year. That's the expectations. And the P multiple right now, as we looked at, is 10 on a non-GAAP basis and closer to 14 on a GAAP basis, right? So 349 is where we're at. So 50 divided by 349, 14.3. So let's just do 16 over here. And let's do a growth rate of 6%, right? Let's just try that. Fair value ends up at around $43. If we go with about 8% growth here, now we're looking at 47, 48. And if we do, let's say 9%, then we're looking at $50, okay? So this is basically what that means, okay? So PayPal over the next 5 years only needs to grow at 6%. The free cash flow only needs to grow at 6%, and the net income needs to grow at 9%. If those two numbers can be achieved, right, and we get a P multiple of 16 and a free cash flow multiple of 14, then $50 today is PayPal's true intrinsic value, right? But if you believe that growth rate is high and it's going to be growing at a low rate, then your intrinsic value is going to be lower. If you believe that that's on the low end and actually the growth rate is going to be much higher, then fair value is significantly higher. But $50, if we match both the fair value and the market price, this is a little bit of a reverse way of looking at it because we're now calculating not the fair value itself, but we're calculating the growth rate needed in order for PayPal to justify today's fair value. So I hope that makes sense, because in our previous analysis, we've usually put in the expected growth rates, right? This is what the growth rate's going to look like, and this is where the fair value is, right? We calculate for the fair value. But in this example, we're trying to reverse engineer a little bit. We're going to match the fair value with the market price and then look at, okay, what growth rate PayPal needs to hit in order to justify today's intrinsic value. And that's a 9% net income growth and 6% free cash flow growth, which I don't think is that difficult because, again, you come back to the numbers from PayPal. Net income has grown at 12%, right? So, yes, the business has more matured since then, since 2012. And I think it's going to be a little bit more difficult now for PayPal to grow, considering the numbers are bigger and bigger and more competition is there. And free cash flow has grown at 17%. So, I think 17% and 6%. I think it's possible. I think it's possible for PayPal to grow free cash flow by 6% to justify today's value, which is at $50, which is going to be the same as the intrinsic value. Now I'm going to be a little bit more, optimistic. Obviously, I think 6% is way too conservative. I think even for me, I think 6% would be really, really low for the free cash flow growth. So if I go with my real numbers and go back to our original type of analysis, 10% growth in net income and about a 10% growth in free cash flows and about a 16 times, free cash flow multiple. Now we're looking at, and then of course we got to account for, let's say, 50% EPS, 50% free cash flow. We're looking at a $61, $62 in the intrinsic value for PayPal. And right now it's starting obviously at 50. So that means 23, 24% undervalued for me, PayPal at the moment. We still got to account for 10% margin of safety. So we're looking at $55. In other words, 11.5% potentially undervalued currently at the moment. But let me know your thoughts down in the comment section below. I would love to know from you guys as well. And as always, if you enjoyed this video, found it helpful, make sure that you drop a like. And, from a technical standpoint, PayPal is hitting a new low, 7-year low. So I think it's got more potential downside here. And the next support, unfortunately, is going to be at $44. I think that's really where it's going to settle in if the selling pressure continues. And we're going to learn more about from the new CEO, the new vision, and what the future is going to look like for this company, right? Is this going to be declining business, or is it going to find a floor and then continue to grow free cash flows and earnings modestly at 6 to 8%? And given that, I think $50, is going to personally for me be a good intrinsic value. But of course, if you're optimistic, it can be much higher than where it's trading at the moment. So let me know your thoughts down in the comment section below. Of course, PayPal has struggled quite a bit in the last couple of years. Year to date, it's down another 31%, so a significant underperformer. But would love to see your comments down below. Don't forget, there is a coupon code Halloween available for the fundamental technical analysis courses, including options course and the bundle as well. Available for the next 3 days, expires after October 31st. And as always, happy investing, and I'll see you all in the next video.